Hi everyone. Thanks for coming today to our webinar, The Five Numbers Every Business Owner Must Know. It's great to have you all live and listening in. We'll send through a recording towards the end as well. But just to jump into things, we will be taking questions and answers. So if you've got a question, feel free to either use the chat section in Zoom or the Q&A section as well. And given that it's just me today, I will respond to those questions at the end of the session as well. So I'll leave a little bit of time within the 60 minutes to cover those off. Um, if you need to leave the meeting, please feel free to do so. If you're registered, which you are, you can always come back in if need be, or as I mentioned earlier, pick up the recording at the end. So just a little bit about myself. My name is Warwick Maddox. I'm the director and founder here at And Robin. We're an accounting, business and tax advisory firm based here in Carlton in Melbourne, and we service clients all across the country. A little bit more about Anne Robin. So we believe that every business owner is a hero building something meaningful, hence the name. We want to be your trusted sidekick, handling the financial complexities so you can focus on what you do best, whether that's in financial planning or trades or retail, hospitality, whatever that is. You focus on what you do best and we'll handle the finances. In terms of our values, the values we live by every day, we're empathetic, invested, we're authentic, and most importantly, we're accountable, both to ourselves and to our clients as well. I like to start things off with a bit of a thought of the day just to get us into the right mindset. So, the budget is not just a collection of numbers, but an expression of our values and aspirations. So, we'll dig into a little bit of that. You'll see that overlaid, that theory, across the reporting we're going to go through in a second. Just an agenda for everyone. So we're going to go through why you need to know your numbers, a bit of a brief overview of some of the common financial reports that you might be working with either us or your accountants or other coaches with. Um, Most importantly, the difference between profit and cash, which is a question we get quite often in our work. What drives business value? So oftentimes people talk about what their value, what their business is valued at. We're going to talk a little bit about what are the key drivers of improving business value. We're going to talk briefly about protecting your assets and adopting best practice as well. And as I mentioned, we'll go through some questions at the end. Okay, so why you need to know your numbers. So this is probably the why behind this whole webinar today. They tell the story of your business. So generally speaking, when we talk to business owners, uh, they'll have a anecdotal kind of idea of where the business is going. We're struggling, or we're doing really well, or we've grown a lot over the past, say, 6, 12, 18 months, whatnot. For the most part, the numbers will tell a similar story. So it's always interesting when we dig into financial reports with our clients that the numbers actually do quite nicely align with what business owners are feeling in the business. They talk about symptoms and root causes. So oftentimes, what we think is an issue in the business is more of a symptom. And oftentimes, we're at risk of putting band-aids on those symptoms rather than discussing or trying to fix the root causes. It can act as early warning signs as well. So, if we're tracking our numbers on a regular basis, we can see trends that are happening kind of before they become a real issue. Uh, Highlight strengths and weaknesses. So if you've ever done a SWOT analysis on your business, oftentimes you might talk about the finances as either a strength or a weakness or an opportunity as well. So they can highlight what's going well and what's not going so well. We don't like to focus all on the negative. We also like to focus on what's working well. Probably most importantly, the last two. So, by having robust numbers that you can track on a regular basis, it allows you to make better decisions. So, a question we commonly get is, can I afford to hire that next person? Generally, the numbers will show some form of yes or no to that. Things like your budgets and your forecasts and where you think the business is going will help you make those decisions more confidently rather than just kind of sticking your finger in the air and trying to guess what the right answer is. And knowledge is power. So the more you know about your business, the more skills and tools you can be armed with as well. Sometimes there might be people looking to buy your business as well. So having the numbers readily available means you can have those discussions in a timely manner as well. The key reports we'll be running through today, trading accounts, profit and losses, balance sheets, statement of changes in equity, depreciation schedules, and shareholder current accounts. Now, you've probably, profit and losses, probably what business owners most are across. Maybe the balance sheet, some of the other accounts you might be hearing for the first time, and that's fine. That's the point of today's webinar. So the trading account, the purpose of the trading account is to track the top of the profit and loss effectively. So it talks about revenue, your variable costs, so the costs that go into making or servicing a client, gross profitability, which you might have heard the term before, and it indicates on a longer term basis whether your gross profit margins are improving, they're staying consistent, or they're reducing. And most importantly, allows you to benchmark your business against other businesses in your industry as well. Um, what I see a lot of businesses not necessarily tracking their gross margin. So what we often see is the revenues and then all the costs will be going into overheads, which is below the gross profit, which I'll show you in a second. So it makes it really challenging or impossible to work out what your gross margins are. And depending on the size of the business, small adjustments can have a material impact on the profitability of the business. So this is a trading account example here. It's fictitious, of course. It is quite old now. But what you can see is we've got our sales at the top, so just over $1 million for this financial year. And you can see our cost of sales. So these are the costs that go into making. So this is a food business. So there's a manufacturing process. So these are things like our raw foods, potentially our packaging, all those costs that go directly into, sometimes it can be labor as well, go into the cost of sales to make one unit of product. So we want to know how many costs are going directly into making a product and what revenue we're generating off that. So you can see from this example that we've got a gross surplus of just under 700K. We have other direct costs, so sales commissions, the direct wages, as I mentioned earlier, the direct costs that can be attributable to manufacturing and selling that product. So you can see here the gross profit percentage is 24%. So what that means is for every dollar of sale that this business makes, when they pay all the direct costs or the variable costs for manufacturing and selling that product, they're left with 24 cents in each dollar. And again, this number is not necessarily that valuable on its own. It would be more important to compare this against previous years or against industry averages as well. So a 24% gross profit margin in this business might be quite good, whereas comparing it to another industry, it might be quite low. And you can see here with just some small adjustments. So if we increase our revenue by 10% and we reduce our cost of sales and our direct costs by 5% each, you can see that the difference is a increase of gross profit of $140,000. So we're not trying to double our revenue or reduce our costs by half or anything. They're small incremental kind of adjustments. um, can lead to quite sizable financial benefits. Now, in the world we're living in at the moment, it's kind of challenging to reduce your cost of sales. It depends on the line of industry, the line of work you're in. It's more probably just looking at scrutinizing the costs where we're spending too much on certain things that we don't need, wastage and the like. So there's the benefit there. And you can see the gross profit percentage has gone from 24% to 35%, which is a sizable increase. Profit and loss statement. So this is probably the report that business owners are most comfortable with. We're tracking the overall performance of the business. We're trying to compare the income and the expenses for a period of time. So we try to match those where possible, so that we get a good sense of what the profit for that period is. And again, to my earlier point, allows us to provide a framework to benchmark results. At the end of the day, there's two main drivers of business value. It's probably the predominant one, that the more profitable the business is, all things being equal, the higher the value of that business. Um, This is a profit and loss here. So you can see we've just brought down the gross surplus from the trading statement that we mentioned earlier, the original one. And you can see there's a lot of different costs in here, whether it be depreciation, which is a non-cash um, expense or deduction if we're talking about tax. We've got rent. These are the types of expenses that can't be attributable directly to the sale of one product. So, for example, the rent doesn't go up by the sales going up by 10% in the last example. Assuming you're staying in the same premises, the rent will be $57,000, regardless of whether this business generates $1 million of revenue or $2 million of revenue, assuming they've got the capacity to generate $2 million of revenue from this venue, that is. So that's why they're called overheads, because we can't attribute them to increases or decreases in actual output of the product or service. Now, this is based on a product business, but it's very similar, or the same premise applies to service-based businesses as well. And you can see here that 248 grand of gross surplus, when you take into account all the overheads, we've actually got a net loss of 113 grand. So in this example, that 24% margin that we had before, or gross profit margin, is not actually sufficient to cover the overheads. Again, if we make some small incremental adjustments, uh, these can reduce things a little bit. Generally, you'll find with your overheads, unless you're spending on things that you don't actually need, you're not going to find sizable savings here. But you can see that the increase down here, the net surplus, that's including the change of from the trading account that we mentioned before. So the trading account sits at the top of the profit and loss, and then the profit and loss sits kind of below it. It's usually one report. So you'll see that there's not as many adjustments here on the overheads. It's more on the revenue and the cost of sales side of things that have changed this position. Again, you can see we've turned a net loss into a net profit, only making percentage-based incremental kind of changes to the trading of the business. I'll just click through that. Terms of the balance sheet, so this is where we're moving more into the assets and liabilities of the business. So the balance sheet measures the net worth or solvency of the business, which we'll go through in a second. And unlike the profit and loss, the balance sheet is a point in time. So where we ran the profit and loss in the last example for the 2020 financial year, being 1 July to 30 June, the balance sheet will be run as at a date. So for example, we would run a balance sheet as at today, 31st of March, 2026. It gives you a snapshot in time rather than a period. but we can still compare it against previous periods. So we could compare it against 31 March 2025, which is 12 months ago, and see how much it's moved from there. Um, and as the slides mention, it's useful for tracking the strength of the business. Effectively, it can be used a little bit for determining the value of the business, but it's a little bit more rudimentary. It's more saying, is the business solvent versus insolvent, or kind of breaking even. But there are a few key ratios we can use on the balance sheet as well. So this is a balance sheet of the same business. So we can see here that the total equity, which is the net worth or the net solvency position of the business, you can see it's in deficit. So there's an argument to say this business could be trading insolvent because it's actually got negative equity. What that means is that the equity is really a function of assets minus liabilities. So we can see if we grabbed our calculator out, we've got total assets of 548 grand, total liabilities of 853 grand, which means that's why we're in a deficient solvency position of 300k. Um, Going back to basics, assets are effectively anything that we own or are owed. So things like our accounts receivable or debtors is money that we don't have in our bank account yet, but we are owed that. We've got property, plant, and equipment that we've purchased. We've done a bit of branding. So these are things that we own, just like your home is an asset. On the flip side, your mortgage would be a liability. So same in a business, you've got liabilities owed to the taxman for BAS and income tax. You might have loans to the bank in the business as well. And you also might have trade payables or accounts payable or trade creditors as well. So these are money you owe to suppliers, example. So I would be somewhat concerned with this net asset position. But just to take through some ratios, so one of the ratios we can do is what's called debtor days. So if we've got trade debtors or accounts receivable, we can kind of work out what the average duration of those debts are. So if we took the debtors of 72 grand, divided it by our total sales, which as we mentioned was just over $1 million, times that by the 365 days in the year, we'd find that on average our debtors take us 26 days to pay. So if your credit terms are to your clients are 7 days, 26 days would be relatively concerning. However, if your trade days were 30 days, then 26 is actually quite good. They're paying on time. And then you can work out how many days to improve it. So if we improve that by 5 days, so if we brought it down to 21 days, then that would actually free up $14,000 of cash in the business, which is great. We can do the same with inventories. So inventories divided by the cost of sales times 365, because we're talking about purchases here rather than sales. You can see it takes us on average about 74 days to turn stock or inventory into a sale. So in a food business, depending on what stock or inventory you're buying, 74 days could be concerning if things are going to perish. On the flip side, if you've got an inventory days of 74 and you're in the building industry, that's probably pretty good because you're likely to hold stock for a lot longer before it turns into some form of revenue. And again, we can factor in an improvement day in here as well. So if we improve that by 9 days, so cut it down by 9 days, that would free up almost $8,000 of cash as well. So this is talking about the cash cycle of the business as well. Now, some businesses don't have debtors or a great deal of inventory. These won't necessarily apply to all businesses, but for more of the traditional manufacturing product, even professional services where they're selling time, like us, you could have inventory days being time that your team has put into completing work. Statement of changes in equity. I'm not going to go through this in too much detail. It really just factors in what money is coming in versus going out from the owners of the business. Sometimes this is done through a loan account, or it could be done on the equity side. So you can see here the opening balances, because we're talking about the balance sheet here, carry forward from last year. You can see there's a loss for the period, so you can see that the deficiency's actually gone down, and this will equate back to that equity that we saw in the balance sheet before. Um, uh, if we've taken dividends out, then that will reduce it further as well. Similarly, we have a shareholder current account. So this is just tracking if you've got different owners or multiple owners, what their balance is at any one time. So it's effectively how much one owner's pulled out or contributed to the business versus the other business owner. So you can see here, we've got Mr. J Doe. He's got an opening balance of 29 grand. He's put in $2,000, so he's actually lent money into the business of $2,000, but he's taken out 8,000 of cash through the year, and he's also paid some personal life insurance premiums through the business as well, which go against his uh, current account. So you can see effectively the net amount of money that he's lent in or contributed to the business is just under $22,000, and you can see from last year it's going down. So he's net pulling money out of the business rather than net contributing it to the business. So it's just a way to track effectively who's owed what out of the business. Um, Fixed asset register. So you might have seen these, especially when you're talking to us or your accountant. Really just tracks the fixed assets, the physical assets that you have purchased. Um, as we might know, when we purchase an asset, generally we can effectively, if it goes down in value, like a car or plant and equipment, they will decline in value over the period of time, over different periods of time, which is called their useful life. So for cars, for example, it's generally 8 years. So effectively, we're depreciating the cost of that car over 8 years. So this fixed asset register is really just a big register to track what the value of those are. So an example here, we've got a bunch of assets classified by category. So motor vehicles, office equipment, plant and equipment. And these are their original costs. So this is how much the business owners spent to buy these assets at various times. The opening value is effectively the value at the start of the financial year that the asset's been depreciated to. So, for example, you can see here with the van, the cost is 22, the opening value is 7,800. So the difference of those of about 14,200 has been claimed as depreciation in previous years. So we've gone 22 minus 14 in previous years, leaves an opening value to start this financial year at 7,800. We've purchased some assets, so we've added some new assets, and we've disposed of a few assets during the year. We've got a depreciation rate which varies again based on the useful life of the respective asset. DV means diminishing value. So what that means is that this 30% will be calculated based on the opening value for that respective year rather than 30% of the cost. So if we did 30% of the cost, you'd see the depreciation each year would be the same. So straight line, as we call it, or prime cost. If it's diminishing value, it means that every year, kind of like your mortgage, each year the interest on your mortgage is going down as you make repayments. Same with depreciation. Each year, as the car or the asset becomes less valuable, we're depreciating it less and less. So it's amortized effectively. Depreciation, so we can generally claim this as a tax deduction in our tax returns as well, but it is an expense in the profit and loss. And then our closing accumulated depreciation is really just the total depreciation claimed to date. So you can see, for example, the plant here, we've claimed 1,580 of depreciation this year, but we'd already claimed 29 grand or so in years prior. So 29 plus the 1.5 is 30,000. So it's really just showing how much of it have we claimed by the end of this financial year. So these numbers are all for the respective financial year, and it just gets carried over. So the closing value will decrease, and then the closing value will become the opening value for next year, and then the process continues until the respective asset is disposed of or sold. So that's the reports I wanted to go through. I didn't want to spend too much time on them. I wanted to go through a few more concepts that we always talk about. So oftentimes I find with some business owners, we place a lot of priority on growing the turnover or the revenue, which is great. It's kind of easy to manage. It's a easy metric to manage. It's easy to run a profit and loss and see whether the turnover is increasing or whatnot. But it's really just a vanity metric. So it doesn't give any sense of indication really how the business is performing. Um, we talk about profit being sanity. So if we've got growing revenue, for example, and we've got growing profit, then that clearly indicates that the business does seem to be going in the right direction, becoming more valuable, more sustainable, whatnot. But at the end of the day, the cash flow is the reality. You can have a situation, and you might have had situations like this before, where your profit is going up, but you've actually got less in your cash account. And there's a range of different reasons for that. At the end of the day, if your cash at bank is going up, then the business is doing well, is my philosophy. So, assuming you're paying everyone on time and whatnot, your suppliers and your staff and the tax man and whatnot, if you're seeing your bank account go up, that's a great sign that the business is doing well and is sustainable from that perspective. Just a few items. I'm just going to consult my notes here as well uh, with the different options here. So I just wanted to run through a couple of items that and how they impact on profit versus cash. So the first one is GST. So when you pay the ATO, your BAS with GST, it impacts on your cash, so it reduces your cash at bank, but it doesn't impact on your profit. So because you're collecting and paying GST to suppliers and clients, that GST money is never your money. We charge it on top of our services, and we pay it on top of the base fee for our suppliers. So effectively, all we're doing is collecting that cash on behalf of the ATO. So when we pay that, it reduces our cash, but it doesn't impact on profit. We're not claiming GST as a tax deduction, for example. When we make loan repayments, so if we've got finance in the business and we make our monthly repayment, again, it reduces our cash. We've got less cash as a result of that loan repayment, but it doesn't impact on the profit because, again, it's debt that we've taken with a bank or a finance company. And all we're doing is repaying that back. So they've given us money or they've helped us to purchase an asset. And all we're doing is we're repaying that. It doesn't have any impact on profitability. However, in saying that, the part of the loan repayment that relates to the interest, of course, it's a part of the repayment, so it reduces cash, but it is a cost of doing business. So interest is an expense from that perspective. Um, the reason being is because, as we know, when we borrow money, let's say we borrow $100,000, we don't repay $100,000. We might repay, let's say, $120,000, and the $20,000 difference is interest. So that 20,000 interest is an actual cost to our business. There's a cost of doing business. So it does reduce our profitability, and it reduces the cash. But the actual principal component, the original $100,000, doesn't factor into the profit. Asset purchases, we're going to assume that this asset purchase is for cash. So if we go out and buy an asset, it will reduce our cash, but it'll be taken up as an asset in the balance sheet. It won't go as an expense in the profit and loss. The exception of that is the actual depreciation, which I'll tick through. So The depreciation, which we mentioned before, is the kind of the decline in value of that asset over time. It's a non-cash. We've kind of already spent the money with the asset purchase, say a year, 2 years, 3 years ago. The depreciation is a non-cash expense. So the accountants will generally journal it into the profit and losses as an expense. It reduces profit, but it has no impact on cash. And the asset sales is the same as the purchases. So if we sell an asset and receive cash, then that cash will increase our bank balance, but it doesn't impact on our profitability. We don't take it up as revenue, unless, of course, we're in the business of selling that asset, in which case it would be inventory rather than an asset sale. So there's a bunch of different reasons why uh, business owners feel like they've got a profitable business, but they've got no cash. And the ATO payments and the loan payments are probably the biggest factors there as well. And also the timing of when we're paying our creditors as well. So they might be in the profit and loss 1 month based on an invoice that we've received or a bill that we've received, but we're not paying them for another month or 2 months as well. So it reduces our cash later on, and it works in reverse with our accounts receivable or trade debtors. So having an understanding of some of these things helps us kind of shed light on why there might be profit but less cash in the business. Um, Next thing I wanted to talk about is what's called the Business 101 cycle. So generally speaking, what happens is when we start a business, as business owners, we invest money into the business. So we either lend money in or we put money in as equity because the business is starting with nothing. So we put money in generally as a personal loan, and then we buy assets. So in the case of the food business we mentioned before, they're buying machinery, they're buying plant and equipment, they might be buying vans, they're buying inventory, so stock, food effectively is an asset as well. And the hope is that we're using those assets to generate income. So we buy these assets and we want to utilize those to generate income. And then hopefully that happens. We've got other expenses going out and we generate, the goal is to generate profit, so a return on those assets. So we want to make sure that whatever we're spending or investing in those assets is coming back to the business as profits or return on investment, return on assets, whatever you like. From that, from my earlier point, we hope that we generate surplus cash from that, so build up the cash reserves, and that allows us to invest in the business more. So buy more assets and generate more income, more profits, generate more cash, and reinvest into the business. So the goal of a sustainable business or a growing business is to effectively try to spin this cycle as quickly as possible. So the quicker we can generate profits from assets and generate free cash flow to invest in the business or take out as dividends or whatnot, profit share, whatever the goal of the business and the business owners are, the quicker we can spin this model, the more successful the business is going to be. Now, we've touched on a few drains and gains here as well. So from a profit perspective, down the bottom right-hand corner, any overheads that are unchecked. So we're spending money on things we don't need anymore. Subscriptions can be a big one here as well if they're left unchecked. But again, sales growth and margin growth, coming back to my earlier example, where we increase the margin, that increases the profit and spins this cycle quicker. On the cash from the cash perspective, again, cash drains are slow paying accounts receivable. We've got an increase in inventories or work in progress, high business loan repayments, business tax payments, or we're paying our suppliers faster than we need to. They're going to drain the cash from the business. Whereas on the flip side, faster collection of debtors, lower inventory levels, again, inventory levels that are sustainable that we need for the business, but not just the right amount, and slower payment of suppliers without hurting our reputation with the suppliers, they allow us to retain more cash in the business. And if we can retain more cash in the business and potentially pay suppliers later, then that allows us to build more assets and generate income faster as well. So I like to think of this as a pretty simple model. Again, the goal is to try and spin through these stages as quickly as possible. And remember, for many businesses, assets are our staff as well. So in professional services like ours, we don't really have plant and equipment or physical equipment other than laptops and desks and whatnot. Our main assets are our staff. So just bear that in mind as well. Turning our mind to drivers of business value. So this is different for every business. So every industry is valued slightly differently. So for example, in some professional services like ours, we will often be valued on a multiple of revenue. The reason being is because a lot of the work we do is recurring in the sense that everyone's lodging tax returns and most people have to come back every year as long as we're doing a good job. But for some other businesses, they might be more transactional. So the level of work they're doing year on year can fluctuate. Some businesses are also highly seasonal as well. For example, tourism operators and catering and hospitality and whatnot can be seasonal. So the importance here is to know what drives business value in your industry. So always happy to have a chat with business owners about that, but it's about understanding, say, that the 3 to 5 key metrics that drive the value in your industry. Examples, monthly recurring revenue, which is very popular in the software as a service or technology space. Revenue growth, revenue per client. So sometimes it's not about the level of revenue necessarily, it's more about have we maximized the revenue per client, or are we just dealing with kind of low fee, low cost kind of clients at mass as well. So there's a bit of a balancing act sometimes. And it depends on where you're targeting the business. Sales and profit. So profit's probably one of those ones that's almost universal. It can be used as a way to value most businesses. The challenge there is sometimes there are businesses that might be heavily invested in physical plant and equipment that might not be yet making enough profit. So the value might be lower from a profit perspective, but they've got millions of dollars of plant and equipment that can be used and potentially sold as well. So for some industries, the actual asset or balance sheet approach can apply as well. But understand the keys for your business. Um, Areas to enhance business value. Having a clear plan is important. It's important anyway, but if you can show prospective buyers or people, investors, whatnot, that you have a clear long-term plan that will increase business value. Documenting roles, so who's CEO, who's chief marketing officer, who's manager of this team in our industry, who's this junior accountant, this senior accountant, whatnot. Documenting those clear roles. Regular reporting, so coming back to our numbers, having good reporting and data coming through, not just on a financial side, but from a marketing perspective or from an efficiency perspective. Should probably be cloud-based just because it's easier to get that data quickly. But again, it depends on the business. SOPs, so standard operating procedures. So we always recommend, where possible, business owners try to document anything and everything in the business. What that means is if a business is looking to sell, or if you're looking to sell your business, then a prospective buyer that's coming through, if they see that operating procedures are there, then it becomes more of a turnkey operation. They pay a certain amount and they can kind of operate it largely the same way from day one. Um, it also allows the business owner to delegate more and free up free up their time, reduce the reliance on owners, which is tied to that as well. So delegating and utilizing other team members or outsourced people as well. There improves business value because the last thing a prospective buyer wants to do is buy pay a certain amount of money and then end up with a 60-hour job. So the more that they can kind of walk in and not have to do much from a day-to-day perspective, you can see the higher the value is going to be for that business. And importantly, identify and manage the risks. So I mentioned earlier the two key parts of many business valuations is profit and the other one is risk. So buyers should be adjusting the business value based on risk. So some buyers are willing to take more risk and therefore willing to pay more. Some are willing to take less risk and therefore willing to pay less. So the less risk a business has, the higher the valuation is going to be. And this is industry. This can be industry dependent as well. So if you're running on a, like say a law firm or a financial planning firm that's heavily regulated, might be the risk might be a lot higher than another industry that's less regulated and has less risk involved. So, whilst we didn't mention these specifically, the main point of this webinar is to talk about the five business numbers every business must know. Um, Importantly, they are the gross profit, dollars, and percentage. The dollars is harder to compare year on year, so that's why we use the percentage, and we get that from our profit and loss report. So if we're not tracking cost of sales, direct costs, and gross profit, I'd recommend looking at restructuring your profit and loss, which is very easy to do to get those kind of numbers. Net profit, dollars and percentage, again, it's probably something we know pretty well because it's usually shown us at when we're doing our tax time, financial reports and tax return. We've generally got a sense of where that is. But again, with these gross profit, net profit margins, I like to see how does that look compared to last year, the year before that as a trend, and also against industry competitors, as I mentioned. Um, the cash flow cycle. We touched on this briefly before in terms of the inventory turnover, the debtors turnover, the creditors turnover. But probably more importantly to that is I like all business owners to have an understanding of from when a job starts or when a product starts being manufactured through to sale and receipt of money for that sale. I like all business owners to have an understanding on average how long does that take. So, for example, in the trades industry, if we win a new client and we start the quoting and we win the project through to completion, generally it could be quite a long time. I know there's milestone payments in the interim, but it can be a long cycle. It can be months and months at a time. Whereas your kind of local cafe, they're buying food and coffee and stuff every day or every week, and they're selling them every day. Their cash flows and they're being paid on the spot. Their cash flow cycle is going to be very small, right? So it's understanding what the cash flow cycle is in your business, and where possible, trying to tighten that. The quicker we can win work or win a job or win a sale and get paid for it, the better because it puts cash in our bank for reinvestment in assets and whatnot. The solvency from the balance sheet, so understanding what the equity position is it positive, is it negative, is it neutral, and how, again, on a trend basis, is it growing, is it staying the same, or is it declining? And if it is negative or declining, then you'd want to put in place some strategies to try and turn that around or stop that as quickly as possible. And business value, it's kind of calculated using a lot of these reports. Um, but again, the most important thing is understanding. what the indicative business valuation is for your business, and more importantly, what are the metrics we need to focus on to improve it. And then again, every 12 months, you can do a revaluation to see is it actually going up and to what extent is the business value going up. You might not necessarily have any interest in selling the business right now, but the business valuations you would do would be just for internal management purposes. Is the business heading in the right direction as a bit of a goalpost? Um, just finally, protecting your assets. So, limitation of liability. So, this is using companies and trusts and whatnot. Um, Determining who should be director or who shouldn't be director as well. Whether there's any security for loans provided. So, are your business loans secured by your residential home property or investment properties or whatnot? So, of course, the less security you can provide, the better, but sometimes it's needed to get the finance you need. Ownership options. So, is there potentially the ability to have the assets of the business or personal assets separate from the trading business as well, in case something was to happen to the business? So, for bigger businesses, sometimes what they will do is they will have all their assets used for the business in one company or one entity, and they'll have their operations in another entity, and they effectively license the use of those assets from that. What that means is if the trading company was to get sued or something happened, then the assets are protected in a separate entity. So it doesn't work. Oh, we don't do this for every business, but it can work for if you've got really high value assets needed to run your business. Do you have terms of trade and credit policies documented? Worth chatting to a lawyer, a commercial lawyer about that. Do you have the necessary insurances? So professional indemnity, public liability, that kind of thing. Anything else you need in your particular industry? Um, Consider financial planning. We're not financial planners, but if you're looking at building wealth outside of the business, then look to engage or talk to a financial planner about that. And estate planning. Do you have your wills and powers of attorney in place? If you've got young kids like myself, do you have guardianship arrangements if you and your spouse were to pass away? So this is protecting your assets and reducing risk. And there's a lot of other things there as well. So adopting best practice, what we recommend is best practice for businesses is to have a business plan, not a big 40-page document that you never look at, but something that's 2 to 3 pages. It's very much goals oriented. These are the goals we're going to achieve in the next 12 months, more action based more rather than philosophical based or theoretical. Having an annual forecast, so understanding where your cash flow is going to be at any point in time, and ongoing reporting, so management reporting and accountability, so engaging a coach as well. A lot of the people we work with, working with either us or other coaches to help keep them accountable. So that's a great way to help achieve your goals. Knowing your numbers is just the beginning. So knowing your numbers is important, but it's more about what do we do with those numbers? What insights and activities does that incentivize? So next step, so get started now. Write down 3 actions or projects that will add value to your business, whether it's from this webinar today or other things you've been to lately. I always recommend at the end of a week having a bit of a sit down debrief as to how the week went and what your learnings were, whether there's any actions or projects from that. A problem is an opportunity to create a project. So if you've got a problem, uh, it's something that we can look at fixing and creating a project about. Some of these things are not big problems or don't take long to fix. They can be short, fairly simplified solutions to them sometimes. But back to my earlier point is we want to understand what the root cause of that problem is rather than just band-aid fixes. And doing nothing should not be an option. So that's it from me. I'm just going to check, just bear with me. I'm just going to check whether we've got any chat or Q&A. If you do have any questions, please feel free to throw them into the chat now, and I'll have a look at those and answer those accordingly. Just bear with me. Does anyone have any questions they want to cover off? Let's see, there's no questions or chat messages at this stage. Um, so yeah, if there's no questions, thanks again for attending and being part of the webinar. We are going to run these monthly. So if I'm just going to throw in the um, actually, Martina, you've got a question. Did you want to type it into the Q&A box and I can answer that live? While you're doing that, Martina, I'm just going to throw in um, the in the chat. If you're interested in attending next month, we're going to run a webinar called "The 7 Ways to Grow Your Business." So again, talking about levers in the business, but it's going to be all around growth. So if you're keen to attend that, I've just thrown the link in the chat. You can jump in and register. That's all live and ready to go now. But as I said, yeah, the plan is to run different topics every month. And what I'm going to aim to do also is get some guest speakers along as well, so you don't have to necessarily just hear from me every month. Martina, is subscription software a fixed asset? For example, Zero or cloud storage? Good question. It's not, no. So because you're not buying the physical, you're really just you're a subscriber rather than buying or building out the asset. The difference there would be, and same as yeah, other cloud storage or software as a service, they would go as an expense in subscriptions or technology or whatnot, because you're paying for those monthly. It does bring up an important point though, that if you're building software, so if you're building in-house software, you've got developers or you're paying external developers to build technology, that would be different. That actually would go as an asset. And generally speaking, there's different depreciation rules on that. It would be amortization rather than depreciation. And it might be over a 5 year period, or it might be something that you can't amortize at all. So if you're building software internally or using consultants to build software, proprietary software, that would be an asset. But yes, subscriptions would be just a business expense straight to the profit and loss. But good question. Doesn't seem to be any other questions. So again, thanks everyone for joining the webinar live. As I said, we'll circulate the recording so you can watch it back if you need to, if you've missed something, or if I glossed over anything. But otherwise, thanks for being a part of it.